Good afternoon from Hong Kong. This is Taimur Beg, Chief Economist, DBS Group Research. I'm joined by my colleagues Radhika Rao and Teng Chua, both of them connecting from Singapore. So this is a strictly WebEx call as opposed to our typical live recording from DBS's Spark Studio. Welcome to everybody's dialing in. We welcome you to our February Micro Insights live stream. What a month it has been. With Trump's administration going on full swing with various measures encompassing immigration, tariffs, reorganization of the US government at a pace that has never been seen before. So lots to take stock. And it's not just a story of Trump and the US and China. There are bigger dynamics at place right now. Both India and Indonesia's economies are dealing with both external and domestic imperatives. And there have been some notable structural as well as cyclical measures taken in both jurisdictions. Radhika Rao, our senior economist, would come after me and talk about that. Singapore, open small economy, hugely exposed to the global dynamic, as well as has its own domestic imperatives and budget issues. A lot has happened there as well in recent weeks and months, and Teng Chua, our Singapore economist, would be covering that. Let me just say hi to both of them. Teng, Radhika, you guys can hear me clearly?
Yes, we can, Taimur. Hello from Singapore.
Yes, perfect.
Excellent. So bear with me for about 15 minutes or so while I go over my slides, and then we can bring in everybody else. Teng, let's just go to the next slide where we have the QR code. Thank you. So those who are regulars to our live stream know the drill. So we have a pigeonhole.at, dbs.pigeonhole.at is the website address where you can go and type macro Feb 25 to submit your questions, or you can keep it simple and just scan the QR code that's on the screen right now and submit your questions. Radhika and Teng will be keeping an eye on the questions, and when our respective sections are done, they will launch this QR codes questions on the screen, and we will take a few of them, time permitting. And fear not, if you have not been able to scan it or type in the address right now, we will bring this slide back to you over and over again. All right, so let's go to the next slide. Basically, my section, and what else but a month of Trump. And I will not necessarily try to parse through all the various measures because there's a lot of noise. And as you know, what's the measure today, 2 days from now could be undone. So I think it's sort of futile to start doing a scorecard on a daily or weekly basis of what instructions are coming from the US government. Instead, I think we should try to take a sense of where the cycle is independent of the Trump narrative and how the Trump narrative is informing and influencing the cycle. Those are the two things that I want to touch on during the course of my presentation. So let's go to the next slide. This is one of those things which is largely independent of the Trump dynamic. The dark blue line on the left-hand side of the panel is showing you that if you had set US core PCE inflation to 100 in 2017, and allowed the line to adjust by the change in core PCE on a year-to-year basis, where would it be today? And especially where would it be today relative to what we have as the dashed line, which is the 2% line? Meaning, if the Fed had succeeded in keeping inflation exactly at 2% every year since 2017, where would the price level be? And where is the price level, given that it has not done that, in the sense that in 2019, 2018, it was actually undershooting the 2% target. And since then, 2020, 2021, it has been overshooting the target in a very big way. Even with a moderate 2.5% or so core PCE inflation for 2025 and 2026, we will see this gap remaining substantial. So over the medium term, the Fed has not succeeded in bringing inflation down to 2% over a cycle, over a year-on basis, neither. This is, again, long before we start talking about Trump tariff and its implication. This is an unchanged policy forecast, not incorporating tax cut, immigration measures, or tariffs. Under even an unchanged policy forecast, we are talking about the Fed being significantly above its targeted price level over the medium term. Now, you could argue, yes, but these are extraordinary times, can't really incorporate the massive one-off shock of the pandemic into these sort of lines. It's unfair. The fact of the matter is inflation was a high for idiosyncratic reasons in 2021, 2022. It's come down a lot. That's what matters. Well, yes. And if you look at the right-hand side of the panel, you can see some of that dynamic at play when we talk about Fed surveys on prices paid and prices received by region. So this is a series of surveys that the Fed does in New York, in Kansas City, and Philadelphia. And these district members represent a wide range of American companies, businesses with very different geographical and business-related orientation. And if you put their survey responses together, what you find is that, yes, they were all seeing tremendous inflation pressure in 2021, 2022, sort of stalled around that point, and then it came down rather sharply in 2023, and has been the case of a sideways journey for a large chunk of 2024. But in the last few months, I think it's already apparent to anybody looking at the right corner of the slide, the dynamic has changed. There's been a drift up, particularly on the prices paid side, and there's been a spike in the last 1 month, in January 2025, of companies saying both the prices paid and the prices received are picking up. In other words, inflation has sort of bottomed out in the US, and we got to think about its ramification for the market, especially as we start talking about Trump policies. So let's go to the next slide, which is titled Unsure Bond Markets. But before I talk about the bond markets, which is the left-hand side of the slide, let's look at the right-hand side of the slide for a second. Slicing and dicing the earlier discussion on inflation data, but this time on core PCE, this number that the Fed pays a great deal of attention to, red line, and the Dallas Fed's trimmed mean PCE, yet another alternative measure of looking at inflation-related dynamic. It's a more squiggly chart. It has more volatility, but as you can see over the medium term, the core PCE sort of intersects the peaks and valleys around the trimmed mean PCE from the Dallas Fed's calculation. So what are we seeing there? Well, what we're seeing there is that in the last few months, inflation has turned volatile and is showing a degree of upward tendency, which we think will sooner or later get picked up in the overall core PCE number. Now let's come back to the left-hand side of the slide. It is basically telling us what the bond markets are doing. Now, if I were to come to you even 2 weeks ago, I would have presented to you a very different set of yield curves because post end 2024, the first few weeks of 2025 was characterized by major upward shift of the yield curve. Since then, the market has rallied a bit. And now the curve for the US is within the end 2024 slide. So it's come down a bit in the long end. There's been a bit of a rally. We are not inclined to buy this rally. This nascent flattening of the curve, in our view, reflects undue complacency on the market's part. We think that there is substantial risk at the long end of the spectrum, whether it is US issuance, whether it is a market's ability to absorb that issuance, and also the entire dynamic around inflation, whether Trump's policies will put the US on a fundamentally different inflation trajectory for the medium term. If any of those things were to transpire, we would expect the curve to steepen, not flatten, and hence whatever has happened in the first 5 weeks of 2025, in our view, reflects complacency than realism, and we think that there is scope for the curve to steepen going forward. Singapore, same story. The MAS has, of course, expressed some degree of dovishness with respect to its monetary policy stance in its last and latest policy meeting. Curves are basically where they were at the end of the year. We do think that if the US curves were to steepen in the coming months around inflation, tariff dynamic, it would lead to some degree of shift up or steepening of the Singapore curve as well. Let's move on to see whether these sort of unrest or confusion around inflation, interest rates is causing any degree of volatility or tightness in the funding market. So what you have on this slide on the left-hand side is the way we sort of track what's happening to funding risks in the United States. Of course, the Fed did cut rates by 100 basis points in the last quarter of 2024, and accordingly, we did see the repo rate come down. But when we think about funding costs, which is sort of the repo minus the effective Fed funds rate, things are not super comfortable. They've edged up a bit, and it's not just sort of end of month cyclicality. There seems to be some additional tightness building into the funding market. Of course, these are modest numbers compared to the battle days during 2008, 2009, when the funding market seized up, but it's worth keeping an eye on, especially when you consider in conjunction with what's happening at the longer end of the spectrum, bond markets. So the bond market volatility is captured by a variety of means. Here we're using the MOVE index, which at some point in 2023, 2024 was showing degree of unrest. It's come down quite a bit since then, but as you can see, it's no longer as comfortable as it was during the post-pandemic time or even the times preceding that. It's a little tighter than that. And I think that this is an area where one needs to keep a very close eye on, especially around Trump's tariff policies. Indeed, if we see inflationary developments with respect to tariffs and immigration and tax cut, at the same time, we see some degree of confusion in the market about what's happening with US issuances, both in the short and the long run, we will see more volatility. When we look at on the run volume at the longer end of the yield curve spectrum, we see that somewhat weaker. The Fed in its financial stability survey in late 2024 flagged this issue. So there are questions around how much stability we will see in the bond market in the rest of the year. My vote is to be definitely a buyer of volatility, meaning the risk of volatility being higher is significantly greater than risk of volatility being lower. Now, we've spent some time talking about inflation outlook, interest rate outlook, market's capability of absorbing high interest rate duration risk, and what's happening with funding. Let's move on to the most obvious part of trade war or trade tariff related policy is the currency. So we go to the next slide, as you can see already that the market is overwhelmingly long US dollar. The red bar here, which is the collection of data on net US dollar positioning from a FX market participants' perspective, it's like the longest we've seen the market in a very long time. So overwhelmingly, people are long the dollar. As you can see at the far right corner of this left chart, that the DXY has given up just a little bit since spiking a few weeks ago, but we don't see any relenting to this for the time being. I'll talk a little bit about Fed outlook later. I'm just talking in general about questions related to the inflation cycle and what happens with interest rate. But yeah, right now, huge positive dollar sentiment. As you can see on the right-hand side of the panel, the DM currency sell-off actually has been even more pronounced than the EM currency sell-off since Trump became president. Everybody's worried about Trump being an equal opportunity tariff imposer. It's not just about China anymore. Who knows, Europe tomorrow, back to Mexico and Canada the day after, maybe India the day after that. And you see that nervousness percolate around the global FX space. But I would say that, you know, the line looks more dramatic than the underlying reality. The FX markets are not very turbulent. Nervousness is there. Some degree of sell-off is understandable in response to tariff. That is the first area where pressure manifests, but that doesn't necessarily mean that the FX market is in a disorderly state or there is huge amount of, you know, bid-ask spread, nothing like that. It's a fairly ordinary adjustment. I think it underlies the view that, you know, we lived with Trump for 4 years. We're going to live with him for 4 years. Let's not get so spooked by the noise. Okay, so that's the FX story. But what about the credit story? Like if you go to the next slide, you see the most incredible sort of development from the past cycle. Hunting, maybe we could go to the next slide. Thanks. Thank you. So the credit spreads are at historic lows. You go to the investment grade space in the US, high yield grade space in the US, or overall emerging market US dollar space, which, you know, the best way to visualize is to go to our macro insights portal. But even here, we can see that the spreads keep on narrowing. Why is that the case? There's so much nervousness around geopolitics. We have 2 live wars around the world. There's general concern about which way economies go. Why on earth do we have, in the middle of quantitative tightening and high interest rates, such tight spreads? I think the only way to make sense of this is to consider the fact that we are living in a world of high nominal interest rates, something that we haven't lived for a very long time. When you have safe asset returns at 4.5%, 5%, you don't need a lot more pickup in yield for corporate bonds to become attractive. So yes, corporate bonds are offering the narrowest spreads since actually in living memory, basically. I mean, even the narrowest that we saw 2-3 years ago were even narrower than that. But at the same time, in nominal terms, they're offering 6-7%. I think for investors who for a very long time post-GFC were used to getting almost nothing, 6-7%, even at historic narrow spreads, makes sense, makes it worthwhile. and hence spreads keep coming down, but because in nominal terms, yields are still very attractive. So credit spreads are historic lows, but they can't go any narrower. So just like I was discussing earlier in the case of US fixed income, I would argue that the risks are asymmetric. The risk of spreads to widen, just like for the risk for curves to steepen, is significantly greater than rates to have any room for further narrowing or for curves to flatten any further. Let's move on to the next asset class, which is equities, the class where we see the most glaring reflection of US exceptionalism. My understanding is that right now on a market basis, US stocks make up about 2/3 of the global market cap, so 65, 70% almost of the entire world stocks are basically valued in US stock markets. And the S&P 500 or the NASDAQ or the Dow Jones all just keep on going up, keep hitting records. The Biden years were fantastic for the stock market, and so far the Trump months have been pretty decent for the stock market as well. The stock market, by fundamental measures, is not attractive at all. If you take 10-year US Treasury yield and you take the difference between that and S&P 500 even yield, we're basically back to where we were in 2007. And we all know what happened after that. Years of major sell-off by 30-35%. Are we on the cusp of something like that? I would argue it is predict. The sentiment in the market is still very constructive. Earnings numbers from US companies are very robust. The amount of dry powder out there, when we look at trillions of dollars sitting in money market funds or in the hands of private investors, means that sell-off will be met by bottom fishing. And hence the market is very well supported from a liquidity perspective, even if the valuation is extraordinarily high. It may have some staying power, but if it doesn't, then we go back to the discussion on financial stability and its ramification. Okay, so we have spent a bit of time so far considering the various dimensions of credit, equity, bonds, and where things can go. Let's now get to the bottom line, the Fed scenario. So Hunting, let's go to the next slide. I normally don't write a lot of words in a slide, but in this one I have. Hunting, could you go to the next slide? Thank you. This is the 3 scenarios. I actually worked on this yesterday morning. Things change so much these days that you got to sort of keep up. And I realized as I was working on the slide that the previous version, which is only 4 weeks old, versus this version are very different. Okay, so 50% probability to what I would call a melt up scenario. And so this is a 3x2 matrix. So we've got 3 scenarios, and around that we're going to see 2x2 or 2 rows with US and Asia implications. All right, so melt up, to which I'm assigning what 50% probability, is where we're sort of heading right now. Very strong growth, sticky inflation, so 3% growth, 2.5% to 3% inflation. But the Fed feels a bit scared of Trump. So at some point this year, they go ahead and cut 2 more times. Could be wrong to do, but maybe Trump's bullying works and they do that. But all of this is music to the market, and the asset prices keep surging, which then in turn makes the Fed give up on any additional rate cut very, very quickly. So cycle ends at 4%, and we go to 2026 with what we call a melt up or overheating set of concerns. What happens to Asia under this? Well, Asian currencies can't really fight the dollar, and if rates remain high in the US, they stay on the back foot. But at the same time, it's not a lose-lose proposition for Asia. I think that the noise out of the US and very strong dollar keep global investors interested in Asia, whose currencies remain on the weaker side, and of course the supply chain issue, the region remaining open to the rest of the world, all that remains. So put all that together, for investments to the region continue unabated. Second is the meltdown scenario. In fact, it is possible to have melt up and meltdown within the course of the same year. So I would not necessarily see the first and the second scenario as 2 distinctive scenarios. They could merge under certain circumstances. So under the scenario, what we have is this Fed being a bit reticent and inflation beginning to show its ugly side, made the stock markets really worry, and then we see a big stock market correction. Bond markets then start to get ahead of themselves and think that if the stock market is going down so badly, we will start pricing in more interest rate cuts because it will percolate through the economy through negative wealth effect and create a recession. And of course, the tariff story and other noise coming from the White House become a negative source of force as far as the economy is concerned. Around that, we might find the Fed wanting to do QE because they want to support the bond market and at the same time cut rates. So we might see rates come down substantially, but significant flattening of the curve around that. This is a scenario that probably should help the Asian currencies. They will probably stabilize with the US dollar sort of starting to sell off. And if the US rates are coming off, there'll be some room for regional central banks to cut rates as well. Final one. I was asked at a senior level meeting recently about this scenario, and I assigned a 10 to 15% probability to that. I don't think anybody in the market is really thinking about that, but we should. This is the reversal scenario. The Fed, by the end of 2025, realizes that the rate cuts in 2024 was just a really, really bad idea. Inflation is at 3%, massive amount of headwind to the economy coming from migrant worker shortage, but at the same time, it's fueling inflation. Tariffs are dampening investor sentiment. There's a lot of noise around that, and tax cuts are again fueling asset prices. And around that, the Fed says, okay, we are really worried about the inflation outlook. It'll take them some time to come to that realization, maybe at the end of this year, fourth quarter, and then they hike. Imagine the repercussions for global financial market around that. US dollar will soar, but at the same time, the yield curve would go through a significant amount of volatility. Initially, the short end would jump and the yield curve will invert. And around that, investment sentiment would really sour across the board. Asia will not be spared because that would be seen as a huge policy error by the Fed in 2024, which will be coming home to roost in end 2025, early 2026. And around that, we will have to entertain a recessionary scenario. All right. Enough about the US. I'm going to conclude my discussion with two slides on Asia. Asia is a trade-intensive region. So let's look at the trade performance of Asia for 2024. On the left-hand side, we basically have indexed trades to 100 US dollar terms, not real export, but US dollar-based exports. And then we sort of look at the total exports for EM Asia or EM Asia ex-China or ASEAN 6. And what we see is that Asia has recovered pretty well from the GFC, from the pandemic. So in 2020, sudden stop, trade collapsed. But after that, the great reopening happened. Trade absolutely surged. After that, trade has more or less flattened out. But if you were to draw a trend line from, say, 2016 to 2019, you would have predicted by 2024 trade to be more subdued than what it really is today. So 2024 was a good year. After the little soft patch in 23, trade came back pretty strongly in 24. We think that trade could probably continue doing well in 2025. But of course, that is independent of what's happening with tariffs. That might have a dampening impact. But I take heart from the fact that global trade has actually thrived despite nearly a decade of trade restriction and tariffs and market access related restrictions. Things have been fine. Companies have been intrepid. They have found market access elsewhere when US turned out to be closed. And those markets then have traded with the US. So let's see how far Department of Commerce in the US go in terms of punishing third markets through which the Chinese trade with the US. If they see some wisdom in toning down the noise, we might actually have a pretty decent year in 2025 for trade as well. China-US trade, you can argue there's only downside going forward, but the rest of the world versus the US, I really don't see it coming down anytime soon, independent of tariffs. Second side of the slide shows country by country. We've taken specific countries here. Indonesia, on the back of strong commodity prices, had a blockbuster export outcome the last few years. But then again, India, China have done pretty well too. Both of their exports are up about 65% since 2016. India ought to do better, one would think, given the geopolitical advantages that it has. China ought to do worse, but China has held its bargain up pretty well as well. But then you look at a country like Hong Kong, which has really, really suffered through this cycle. All right, final slide. I want to end with my trade war vulnerability slide. It's very simple, not really doing a very deep analysis of trade vulnerabilities. It is plain and simple. What percent of your exports go directly to the US? What was the percent in 2016? What's the percent in 2024? Sometimes simple charts tell you pretty compelling stories, and I think this one does. You can see already that Vietnam, Taiwan have really, really ramped up their exposure to the US over the past 8 years. After that, the evidence is kind of really, really mixed in the region. Look, you can say Thailand has gone up a little bit, its shares. Same thing for Korea. But then you can also look at the stark example of China, which used to send about 18% of its total exports to the US in 2016, today less than 15%. And then you contrast that with India, which is never seen as a huge trade vulnerable economy in the trade war. But check this out. Their trade share with the US has gone up substantially, and it is basically where China's was back in 2016. About 19% of India's exports now go to the US. So India, of course, has been very cautious in dealing with the US in the last couple of months, trying to be super nice with respect to immigration measures and tariff and so on and market access. And I think it's hoping that those overtures will lead to it maintaining its market share with the US. I would be a bit cautious because I do think Trump is capable of jumping one day into tariff measures, even against an ally like India. If he can go after Canada and Mexico, why can't he go after India? So let's keep an eye on countries which have seen their trade share with the US go up substantially in recent years, particularly India, Thailand, South Korea, Taiwan, and Vietnam. And then we'll see whether the US government goes country by country, thinking that those countries that have seen a big jump in the trade share with the US over the last 8 years are basically backdoors for China to access the US. All right, so that's it for my section. One more time, next slide. Reminder to you that you can scan the QR code or type dbs.pigeonhole.at and enter the password macrofeb25 to ask us questions. On to you, Radhika.
Thank you so much, Temur. Hi, good evening, everyone. Thank you for joining the call. So taking on from what Temur left off at, to do with trade and tariff, let me give you a peek into the dynamics for India and Indonesia. The flow that I'm hoping to follow is this, which is basically what are these countries doing in terms of the impending risks. And of course, on a day-to-day basis, there are tariffs being imposed and tariffs being removed. So quite a lot of uncertainty on that front. But I'll touch upon the preemptive steps and then go on to discuss a bit of the domestic dynamics and end off with the currency. And I think that has been quite a discussion point, especially between yesterday and today. So going on to the first part of my discussion, which is on the tariffs and trade, just like Temur mentioned about India, which has been a long-time ally for the US. For the US, in fact, India's largest trading partner is in the US. They also have strong security as well as diplomatic relations. And as you can see in the chart, India's exports to the US or US imports from India have been consistently on the rise. And especially since after COVID, you can actually see a sharp rise in terms of the goods trade to the US. In fact, it's not only just the goods, but also if you see the services trade balance, India runs a surplus with the US, especially in terms of service exports like software, and more recently now, you've seen a lot of global capability centers being set up in India as well. So in terms of trade, US runs a lot of trade deficits with many countries, and India is not among the top, say about 4 or 5. And nonetheless, it's been consistently, US has been running a consistent deficit with India. And when you look at the sector breakdown, you kind of see, sectors where India's sales to the US is quite big, especially sectors like pharma. And telecom instruments is something more recent. That's to do with mobile phone exports. You would already be in the know that one of Apple and it's part of its ecosystem has moved into India. They've been expanding at a very rapid pace. You've actually seen some of the local players also participating quite sizably in that Apple ecosystem. Have also bought up some of the OEMs. So from that angle, you've seen actually exports to the US increase as well. And the other sectors are, of course, electrical machinery, equipment. Now, coming back to the part on tariffs, in the next slide, and essentially show that from the US, in fact, the US has, the President Trump has mentioned in his speech quite a few times that has highlighted the number of tariffs that India has, tariff as well as non-tariff barriers that have been placed by India over the past few years. And what you've seen as a preemptive step by the Indian government is that the budget that was released earlier in the month, they've actually made a concerted effort to reduce some of the import tariffs. At the same time, India also has a special program wherein it attracts investments and gives out incentives. That's under the umbrella of production-linked incentives. And in the budget, the government has actually increased allocations towards this PLI program or PLI mechanism. And you can see the breakdown chart on the left. Off late, or in fact, for the past few years, whenever PLI allocations are made, the lion's share has been going to mobile phones and electronic components. Tying up with what I had just mentioned, that part of the ecosystem has been growing very rapidly in the country. Apart from, of course, other priority sectors like auto, pharma, food processing. So there's a list of about 14 to 16 sectors where PLI allocations have been going. Again, this is an attempt to attract more investments into the country and also being more export oriented from the same tune. So insofar as preemptive measures is concerned, import tariffs have been cut. It's been made easier for companies to come and set up base. And also there is an emphasis on regulatory reforms. So there are going to be some committees that are going to be set, which are going to comb through existing regulations to try and provide ease of doing business. You've also seen an increase in the FDI towards insurance sector from about 74% to 100%. So these are some of the measures that have already been undertaken. At the same time, Prime Minister Modi, the Indian Prime Minister, will be in the US later this week. And there's been, no official word, but there's a lot of speculation that India will look to give some concessions, will also try to step up purchases from the US in terms of energy as well as defense equipment. There could also be a conversation around a limited trade deal to address some of the market access concerns. We'll wait and see how that pans out. But this is, again, an attempt to keep relations more cordial. And especially also, you've seen this new announcement on steel and aluminum tariffs being imposed across the board. So India does sell those products also to the US. So a lot of back and forth expected in this space. From India's side, obviously, looking at keeping and reinforcing relations. In the next slide, then, I go on to talk about more domestic issues, especially, and I think this ties in with what's happening on the currency side as well, as I will add very shortly. Now, if you've seen the regional central banks, the Fed's path ahead is quite uncertain. And you saw in Taimur's slide that there were a few scenarios one could build in terms of how the next few months pan out. And what you've seen as response in the regional central banks is that they have gone ahead and done, undertaken rate cuts if their domestic priorities require such, which is basically, if they need to attend to growth, if there's some inflation worries, if they have currency issues, they've been trying to balance those priorities. For the central bank, what they have done is that there is a squeeze in the rupee liquidity onshore. So if you've seen the banking system liquidity and what we also call core liquidity, these gauges kind of are in deficit, in deep deficit. So part of this deficit has been a function of what has happened in the currency markets. But what the central bank has done, say about a week or 10 days back, is to come out with a host of measures to try and provide relief on the liquidity front. So they've done several tools, right? Everything from open market operations to FX swaps to overnight repo auctions. So the combination of action or measures being undertaken to provide some relief on the liquidity front. And while that has been playing in the background, then other part that has played out, which is visible, is on the policy or rate movement front. The RBI has not changed or had not moved for nearly 2 years. And you saw them then follow up with a 25 basis point rate cut late last week. So what would the change in their bias? Essentially, they mentioned that the inflation was acting according to expectations. It was going to align with the target down the line over the next few months. They also expressed that they'd already taken some amount of liquidity action. They did not commit to any further support, but they did say that on an ad hoc basis, they will continue to act. But they were also wary of giving an outright dovish signal to the market. So they kept a neutral stance while assuring that they are all hands on deck in terms of financial stability. They will and act if required, according to market conditions. And overall, in fact, this 25 basis point cut was along our expectations. We are looking for 50 more during the course of the year, and the next one could be as early as the April meeting. In fact, we are in agreement with the central bank in terms of the inflation path ahead. We do think that within 3 months, it will be at or a bit below the 4% target. Going to the next much spoken about topic is the currency, as you'll see in the next slide. In terms of the currency, we really break down the currency movements in, say, in the past 7-8 years. And you see first part where intervention in the currency was much more one-sided to mean that the dollar rupee consistently continued to adjust up. So that is a weaker rupee. Then came a phase when the rupee movements were quite guided on very minimal on both sides. So you see a rather flat profile. And since late last year, the dollar rupee has begun to adjust higher, which is a weakening in the currency. Of late, we have been seeing the dollar rupee touch record highs or rupee record lows. And in fact, the very recent move between yesterday and today, there's been a very sharp and outsized adjustment higher in the dollar rupee. And not surprisingly, that's why the central bank has shown a very clear hand in terms of intervention. Market speculation is that anywhere between 9 to 10 billion has been spent just between a couple of days to try and squeeze out the speculative bets against the currency. So the central bank has been active quite decisively, and you've also seen concurrently them taking liquidity measures as well. Part of this problem has been accentuated because of capital outflows, especially on the equity end. You can see in the chart here, equity in the past 4-5 months has seen quite sizable outflows. Interest in debt is kind of coming back. Part of it also because India is now a part of global fixed income benchmarks, and so a bit of passive names still putting their bets on the Indian paper. And of course, as the build-up and rate cut expectations happen, that's also been another thing which has drawn in interest. In the next slide, then we just I wind up this discussion on the rupee. We do see scope for further dollar rupee movement higher. In the very short term, I think the central banks would like to act if the move is very outsized. So despite that pullback and a bit of a volatility in the near term, we do think based on our FX strategist dollar call that there is some more room for dollar rupee to adjust up, and we expect a break into the 88 handle over the coming few months. So this kind of winds up my discussion on India. Let me quickly shift gears towards Indonesia. And here the flow I was hoping to do a cover is, very quickly take a stab at the first 10 days, 100 days of the new government. Then what Indonesia has also been doing in terms of flows and defending against tariff risks, and BI at the very end, who like RBI has also is acting and prioritizing domestic concerns. In the first part, the new government that took over in October of last year, you in fact see, if you could move to the next slide, we will just see a take on what are the priorities for the new government. They've actually been quite pro-consumption, wanting to invest a lot more into human capital. So there's been, a new free meal scheme has been introduced, which is already underway. There'll also be free health checks that will be provided. Then you've got some support for the housing sector. They've also been, there was a 1% VAT increase that was scheduled for this year. That's been pushed to next year. So from all these angles, they have looking to provide some boost for consumption and also try over time to improve the human quality index. At the same time, you've seen, you need to make space for all this expenditure, right? And as you can see, the chart on the right, revenue growth has been, quite muted last year. So they're cognizant of that hurdle. The effort has been to rationalize expenditure instead. So the president has made a very big push. Almost 1.2% of GDP worth of expenditure cuts have been announced. You have seen cuts actually happening across what we will call revenue expenditure or operational costs, as well as towards capital expenditure. So cuts looking, the target is going to be much more wasteful, non-development kind of spending. but you do see that in this context, there could be some, axe could fall on some productive expenditure as well. And the third and final one, of course, is international relations. Indonesia's president has been traveling and meeting up with many other national governments as well. Most recently, he's become a part of the BRICS group. And again, looking at strengthening investment as well as diplomatic relations with number of countries, including Japan, China, as well as other Asian countries. So it's been a busy first 100 days for the government. I think going forward, in terms of growth, we do expect the immediate impact on growth to be bit small. And in fact, first half of the year, we might see a negative impulse on fiscal spending, which might, the books might catch up in the second half. Overall, expecting a growth target of about 5.1%. From the first 100 days of the government, let's go towards tariff risks. In a way, contrast to India, where US is the biggest trading partner. For Indonesia, China is very key, right? If you look from an investment point of view, from a trading partner point of view, the share of China as a customer for China, for Indonesia has gone up consistently, and especially in the past decade. And this, to some part, also plays into Indonesia's efforts in trying to move up the value chain, especially in the commodity sphere. So for the longest time, Indonesia was a key raw material exporter. It's looking to, and it has been looking to move up the value chain. And when you see the next chart, you will see that has paid off in some respect. We'll come to that in the next slide. But here you can see, for instance, that while US's share in overall Indonesia's exports has fallen, but on a nominal basis, it's still quite high and rising, right? So from that point of view, also, if US was to look at which countries run a trade deficit with the US, it will certainly look at Indonesia as well. And I would just recall here that the previous administration, the Biden administration, when they had efforts to onshore investments called the IRA Act, under that, Indonesia was trying to reinforce its relations with the US to be able to supply raw materials to them, especially materials like nickel, for instance, where Indonesia has a natural strength. So we hope and assume that this is going to be the push for the new government as well, that Indonesian government will reach out to the US authorities to try and keep a smooth relationship, especially insofar as natural resource and downstreaming sectors are concerned. In the next slide, we will just touch upon the shift, like I mentioned earlier, from raw material commodities to value-added shipments, right? Indonesia has really seen a lot of success on this front. FDI has been consistently hitting new highs over the past 4-5 years at least. As of 2024, we are at just above 60 billion. And a lot of this interest has been in the base metal processing space. As you can see in the next slide, it highlights where this big jump has come from. And bigger FDI has also meant higher exports, and especially, again, sectors like nickel and articles of iron and steel, as well as iron and steel itself. So that movement has been quite successful. I mean, the government has higher ambitions, and we do think that as more investments go into this space, that's going to be achievable as well. Of course, they still have to be balanced with the country's own, green initiatives and clean initiatives as well. In the next slide, then I go towards BI. And just like the RBI, we do expect BI to also, prioritize its own domestic concerns, especially as far as growth is concerned. We have our own in-house consumption gauge for Indonesia. And what that's telling us is that it's been softening of late, right? You've got, real wages that were low because, inflation has been consistently, I wouldn't say high, but it's been consistently above target for a good part of 2023. 2024, it started to stabilize and edge lower. But still, it's only now that you've seen real wages improve. So there has been a bit of pressure on the household balance sheets, and that has kind of slowed down consumption. But nonetheless, the BI has a significantly large real rate buffer, especially when you do the benchmark rate versus inflation, and that has allowed them to go ahead and cut rates. We do expect, they have done a 25, we expect at least another 50 from them during the course of this year. The currency has been weakening, but they are looking at currency as a problem that's caused by more global factors, and they will look at intervening in that market to try and support the currency. I think with this, I will wrap up my side, and we have this Pigeonhole link again for you. Please do go onto the website or to the QR code to try and enter questions that you might have from Temur, mine, or Hunting's content. Over to you, Hunting.
Thank you very much, Radhika, for the extensive discussion. So let me jump right into Singapore. And here's the agenda that I would go through. Firstly, keeping in line with the tariffs implications, I'll touch upon that. But also at the same time, I think there's quite a lot of developments to continue to try to attract investments, and that is seen through greater intra-ASEAN collaboration, especially through the Johor-Singapore SEZ, which I also touch upon. And lastly, I think the next big policy announcement would be Budget 2025 on February 18, just next week, and we'll give some highlights on what we can expect. So firstly, just in terms of tariff implications, I think our view on this matter has been that Singapore would face more indirect impact, probably on the negative side, rather than direct impact. So I mean, after all, Singapore is a very trade-dependent economy, and therefore I think the implications if the global trade cycle starts to turn lower, that will have certain negative implications on Asian exports as well as Singapore exports. And we can really take cues from the Trump 1.0 episode, where we see that Trump tariffs first came in sometime early 2018, and then at that period of time, I think the trade and electronics and manufacturing cycle started to peak, and that subsequently with that policy uncertainty resulted in eventual contraction in Singapore exports as well as Asian exports in 2019. I think at this juncture, the external demand conditions that Singapore is facing is still quite resilient, and that would probably still hold up in first half of 2025. But I think as the year progresses, with some of this uncertainty with regards to tariffs, that could have a negative impact as the year progresses. So that would be more on the indirect impact, whereas I think the risk in terms of direct impact from the US would be limited. I think there are a few reasons for this. Firstly, just looking from the US perspective on this chart, US actually ran a good trade surplus only with Singapore within ASEAN 6, meaning that within ASEAN 6, actually, in fact, US run the biggest goods trade deficit with Vietnam. So in that respect, I think Singapore is more insulated. And another few factors to consider is that I think Singapore has quite close relationships with the US. Just looking from the trade perspective, US and Singapore enjoy quite good trade relations, in that both countries just actually celebrated 20 years of FTA between these two countries in 2024. And in fact, I think within ASEAN, Singapore is the only one that has an FTA with the US. And certainly, I think another point to consider is that US is a major investor in Singapore. And if you look at the numbers, actually US account for around 53% of fixed asset investment commitments into Singapore on average between 2022 to 2024. So in that regard, within ASEAN 6, Singapore has the most limited risk with respect to the direct implications from US tariffs. So now I think one of the ways that the region is trying to continue to seek opportunities amid this geopolitical fragmentation is through bilateral collaboration. I think this is really clearly seen in the Johor-Singapore Special Economic Zone. And here we really see a new dawn where the agreement is being formalized by both countries earlier this year. And the SEZ basically try to try to leverage on the complementary strengths of both sides, which I'll touch on more. But basically, the SEZ will comprise of 9 special zones within Southern Johor, and with each 9 of these zones in Southern Johor focusing on different economic sectors, and as you can see here on the left map. And here I think Singapore can really tap on this SEZ, as this SEZ is actually more than 4 times bigger than Singapore, and therefore allows Singapore companies to be able to navigate and with Singapore facing some of these domestic constraints, such as in the areas of land. And we look at the SEZ, they are actually quite comparable in size with the Shenzhen and Hong Kong SAR combined. So now touching on the complementary strengths that businesses can leverage on, I think one key area is Singapore capabilities as a business hub and financial center. And here I really like to look at Singapore's competitiveness using this IMD World Competitiveness Ranking. This is a quite good indicator in that it tries to track competitiveness among countries through economic performance, government efficiency, business efficiency, and infrastructure. And we can see here Singapore does quite well. In fact, here the lower means the better. But I think what is not shown here is that Singapore actually has a quite high cost structure, whether it's in terms of labor costs. And here I think that's where Johor can come in. So we can see here that firstly, Singapore can benefit from Johor's faster population and growing workforce. We can, based on the official estimates and numbers from the UN, Johor workforce is actually expected to grow at a faster CAGR of around 1% from 2023 to 2035 compared to the slower rate of increase of Singapore, which is also facing a tighter labor market. Secondly, I think the other strengths that Singapore businesses can leverage on is the lower median wages in Johor, which is well below that of Singapore. So that would relieve some of the cost pressures that Singapore businesses are facing. Now, let me dive a bit more into the SEZ agreement that was signed earlier this year. Basically, there are 4 key areas. I think this set the broad contours of what to expect over the coming years. And I think there are basically it tries to create a dynamic and integrated economic hub. And on the economic cooperation side, other than the 9 zones that I mentioned and the 11 economic sectors, I think there are certain targets that are put in place, such as to attract 50 high-value projects in the next 5 years, as well as hire 20,000 skilled workers in the SEZ. Certain things, the second thing is regarding the movement of people and goods, really to try to be a dynamic and integrated economic hub. You really need that movement of people, as well as encouraging that trade to encourage investments to come in. Thirdly, there's in the area of talent development based on the early initiatives that we have seen between the 2 countries. There's a collaboration between sort of the high education institutes between the two countries to try to have the development of talent to cater to some of the needs that are required of these businesses. And lastly, I think ease of doing business is quite of critical importance to the SEZ. And here, I think Investment Facilitation Center is already being set up in the Forest City, and that should be getting going by February of this year. Other than that, I think we've seen quite some supportive policies. So 2 separate dedicated funds will be set up from each country. So I think Malaysia's would focus on infrastructure as well, and then Singapore would encourage some of these Singapore businesses and MSCs that are looking to expand in SEZ. As well, I think Malaysia has rolled out some tax incentives package that's quite comprehensive, so can take a look at their website for it. So ultimately, I think it will be a phased development. There are 3 key areas to watch post-agreement. I think firstly, there will be more regular quarterly meetings between the 2 countries to hash out some of the ongoing issues that still take time to work out, including that I think that is closely being watched by investors, such as the harmonization of regulatory framework and processes, for example, in the area of trade. Thirdly, I think to try to improve movement of people, the RTS link development is still ongoing, and that would probably be completed from end 2026, and that will significantly improve the movement of people from hours to 10 to 15 minutes. So thirdly, let me touch on budget 2025, and that would be one critical piece to Singapore's macroeconomic policy. And I think that budget 2025 would take quite a supportive stance. First reason is that what we have seen is that there's fiscal outperformance in recent years, and this provides some fiscal flexibility in the upcoming budget. That's because the government has the budget balance rule, and therefore with fiscal within the current term of government, and therefore with fiscal outperformance in the earlier years, there's some room to run down some of these surpluses that's been accumulated. So ultimately, what we are expecting is that the for budget 2025 is likely to have a 0.5% of GDP fiscal deficit, so around SGD 3.8 billion that we are expecting to be announced. So 2 key areas that I think budget 2025 would try to address are trying to manage dual priorities. So near-term cost pressures, as well as balancing that with long-term initiatives with regards to Forward Singapore, trying to refresh a social compact and to ensure that the economy continues to thrive amidst this global uncertainty. So just firstly on near-term cost pressures, I think there are 2 areas basically that pertains to households and businesses. And I think on the consumer side, what we have seen is that inflation is coming down, but consumer price level remains elevated. And therefore, I think there's some room for some measures that are quite similar to what we have seen in previous budgets, such as CDC vouchers, to be rolled out in this upcoming budget. The second one is with regards to manpower costs, and we could see certain extension of policies such as the progressive wage credit scheme, for example, to try to alleviate pressures on that front. Lastly, let me touch on some of the long-term initiatives that might be announced at budget 2025, and I think on the household side, this will cater to families in 3 various aspects, trying to boost the fertility rate. We already heard from the National Day rally that there'll be bigger support a new scheme for larger families with 3 kids and above. Caregivers continue to be of priority as they help to balance, have multiple responsibility within Singapore families. And I think seniors will continue to be a priority as with an aging population, the Singapore government will continue to want them to age well in that regard. Secondly, on the business side, I think there will be efforts to sharpen the economic competitiveness, and there will be 3 areas with regards to upscaling, trying to help companies to internationalize to growing markets, as well as I think Singapore is an international financial center. There are some efforts to revitalize the equities market, and that could even involve introducing some government seed capital. So that sums up my part on Singapore, and let me pass back the time to Tema.
Thanks, Hunting. Let me actually pass the time to
Thank you so
Radhika,
much,
because she'll be moderating it. Yeah.
Hunting. Yeah. So let me then probably we just take another 4-5 minutes to try and pick some of the questions that were posted by our clients. So I hope the screen is visible where I've tried to put up some of the questions that was posed to us, especially from the Pigeonhole. So let me pick up some, and since Hunting you just spoke, let me take questions that were a bit relevant for you. So I think you did spend a fair amount of time talking about some of the sectors. So do you want to just dwell on this question? What are the key sectors that will benefit from the SEZ? And I think I'm sure in your interactions with clients, this has been one of the important questions.
Yeah, I think a number of sectors that will benefit. I think one would be data centers, which already seeing quite huge interest. So that's one. Secondly, I think in terms of electronics, there's benefit for some of the design work to be hosted in Singapore, but some of the assembly related activities might move to the SEZ. And lastly, I think, for example, in the areas of renewable energy, that could be one area that might be benefiting from the SEZ as well, given the importance as shown in the MOU and the agreement.
Great, thank you so much. Let me then, Temur, if you can hear us.
I can hear you, Radhika, loud and clear.
Quite often, especially with Mr. Elon Musk at the helm. Do you think the US DOJ will be successful in cutting government expenditure?
Okay, so DOGE, the Department of Government Efficiency, which also is an acronym that reminds people of a term in the Medici dynasty in the Italian history. Look, the noise is substantial in terms of sending very dramatic notices to lots of people that their services are no longer required, and there's a lot of suspension of payment going on. So I think in the short term, we might see some savings incurred out of that. But US is a litigious system. Government workers do have rights. I don't think they're going to be able to fire so many people so easily. Expect some degree of quagmire, some degree of pushback from the system, whether it is federal judges or Congress, because at the end of the day, not all the money, despite all the allegations, is spent on zero value added items. There are Americans who benefit from USAID projects. There are Americans who benefit from things that the Department of Education, Department of Health do. Once those checks and funding start being suspended, there will be a lot of pushback. I don't think DOGE will be able to carry out trillions of dollars of savings as it purports to do. It will succeed in severely hampering US government capabilities in the near term, no question about that. And that might lead to some degree of saving. You can see it in the fixed income market. The market seems to believe that Trump will be able to use Musk as a shield and go ahead with all sorts of expenditure cut. I know lots of people who also believe that, and that would lead to a positive fiscal surprise. I have severe doubts about it. The key parts of US expenditure outlays are rather inelastic, and these sort of noisy firings and expenditure suspension announcements don't really amount to a very large saving. So I am very skeptical. I am very, very happy to be proven wrong. We all would like to see US curves flatten. That would be a positive development for the global financial system. I'm skeptical.
Thank you so much for that. Let me combine, two questions that are asking about the Fed. Surely, we start off if you remember September of last year, the expectations that the Fed would cut by almost 150 basis point, and here we are, a complete different landscape. Any clarity on the Fed's path ahead? What are your expectations?
Right. So Radhika, let's make that the last question, given that it's already 5:06. So let me just say that the Fed is trying to push through an extraordinary cycle. This is not the cycle that we have seen in the last half century. Typically, the Fed cuts rates in anticipation of a major labor market slowdown or a major ongoing economic disruption. In this case, none of those things were visible in September. The Fed decided to do something atypical, which is extend the cycle by cutting rates because it expected inflation to be moderating. I think at ex post, looking back in hindsight, it was a mistake. Curves steepened substantially after the Fed rate cut, pricing in no recession, which is fine. But now that the fact that inflation, as we saw in some of the slides I saw earlier, is beginning to bottom out and there are upside risks to inflation, even without Trump's policies on trade tariff or immigration, even without that, there are upside risks to inflation, means that the Fed needs to be very vigilant going forward. Our view is that at most 2 more rate cuts in this cycle, second half of this year, but the risk of the Fed not being able to cut at all in this cycle is gathering substantially. And as you saw in my 3 scenario slide, we're also looking at a 15% probability of the Fed might even have to hike at some point. Let me just end right there.
Thank you so much. Do you want to give some concluding comments?
Well, thanks everybody. We did this between Hong Kong and Singapore. I think it all went pretty well. We will try to make sure that we do an in-person one with sharper video next time. But thanks everyone for dialing in. Stay healthy, stay safe. We'll see you in March.
Thank you very much.
Thank you.